Imagine measuring distance with an elastic band. The thing you're measuring might move, but the ruler in your hand is moving too. Every reading you take blurs two completely different phenomena: changes in the world and changes in your tool for measuring it. That's exactly what we do every day when we price the world in dollars. In the next 8 minutes, we're going to do something different. We're going to change the ruler. We're going to price oil, equities, real estate, and the entire global commodity index in a single asset, gold. And watch how the picture transforms when the unit of measurement stops moving. When we say oil is expensive, that food prices are soaring, that commodities are entering a supercycle, we are almost always speaking in dollars. But the dollar is not a fixed unit. It expands and contracts with credit cycles, policy decisions, banking crises, and the shifting confidence of its holders. Pricing in gold is a way to swap rulers. It doesn't require you to predict the gold price. It doesn't require ideological commitment to a gold standard. It requires only a willingness to ask a cleaner question. How much real stuff does it take to buy other real stuff when measured in something that cannot be printed? Gold is not perfect. No yardstick is. But it's the only monetary instrument that has survived every monetary experiment of the past 2 centuries. Bretton Woods, Nixon's closure of the gold window in 1971, the euro experiment, the era of quantitative easing, survived all of them. The currencies it was compared against did not always fare as well. The first thing that strikes you when you look at a commodity index priced in gold over 2 centuries is how different it looks from the dollar version. In dollars, the index drifts upward, slowly at first, then with steepening pressure as the 20th century progresses. It's the chart that underlies every "inflation is permanent" narrative, every commodity supercycle thesis, every anxiety about resource scarcity. In gold, the same index does something structurally different. Across the 19th century, the early 20th, even significant portions of the modern era, it trends flat to downward. There is no persistent upward drift. There is a cycle around a slowly declining mean. This is not a paradox. It is a description of what civilization does to raw materials over time. Agricultural yields have multiplied, driven by mechanization and the nitrogen fertilizer revolution that synthesized abundance from the atmosphere. Mining has grown progressively more efficient. Transportation costs have collapsed since the age of sail. Substitution turns one generation's scarce input into the next generation's obsolete technology. Remove the monetary noise, and the underlying signal of human productivity becomes visible. Commodities, broadly, become cheaper. Every serious examination of long-run price data encounters the same inflection point: the early 1970s. In dollar terms, the commodity index doesn't merely accelerate, it changes character. The gentle drift of the preceding century becomes something qualitatively different. More volatile, more intense, subject to swings the pre-1970s data rarely produced. The break is jarring. It demands explanation. The explanation has a date: August 15, 1971. On that day, the Nixon administration suspended dollar convertibility into gold. It ended Bretton Woods, the arrangement under which foreign central banks could exchange their dollar reserves for U.S. gold at a fixed rate of $35 per ounce. It was presented as temporary. It was permanent. And its consequences, still unfolding more than 50 years later, are etched into every long-run price chart in existence. Before 1971, the dollar's link to gold was a binding constraint on credit creation. The United States could not issue more dollar claims than it could back with gold without triggering a run on its reserves. That constraint was uncomfortable, periodically binding, and ultimately abandoned when the costs of Vietnam and the Great Society made the fiscal arithmetic impossible to square with convertibility. After 1971, that constraint vanished. In the decades that followed, global credit expanded from roughly $10 trillion to over $300 trillion. The dollar lost the large majority of its purchasing power in gold terms. The most useful application of the gold-priced view is regime analysis, stripping the monetary component out of the price signal and seeing what's left. The 1970s, in popular history, the canonical decade of commodity-driven inflation, oil shocks, OPEC, wage price spirals, the dollar commodity index surges. The narrative writes itself. But priced in gold? Gold rose from $35 in 1971 to $850 by 1980. The commodity index, expressed in gold, fell sharply across the decade. The commodities were not becoming scarcer, they were becoming cheaper. What was rising was not the cost of the physical world. What was rising was the price the market was willing to pay to hold gold, a direct reflection of collapsing confidence in the post-Bretton Woods dollar. The 1970s were primarily a monetary crisis that expressed itself as a commodity crisis. The 1980s and 1990s tell the mirror image. In dollar terms, commodities looked subdued. The standard story of Volcker's tightening restored credibility, globalization. In gold terms, commodities actually strengthened across much of this period because gold lost relative ground as confidence in dollar institutions recovered. The early 2000s commodity boom, conventionally attributed to the China factor, the industrialization of the world's most populous country. That story is true as far as it goes. But priced in gold, the boom looks considerably less impressive. A meaningful portion of what was celebrated as a supercycle was, again, a story about dollar weakness, the legacy of post-dot-com monetary expansion. The pattern is consistent across regimes. When money is being debased, the dollar chart overstates the real scarcity story. When monetary credibility is restored, it understates it. The gold lens does not eliminate the commodity cycle. It reveals it more clearly. Apply the same lens to the principal asset classes of modern wealth, and the picture sharpens further. Equities. The S&P 500 has compounded at rates that made it the default destination for long-term savings across the developed world. Priced in gold, the story is more nuanced. Long periods of genuine real wealth creation alternate with extended periods of mean reversion, in which nominal gains mask the erosion of real purchasing power. The Dow Jones, measured against gold, peaked at a ratio of roughly 45 in 1999. By 2011, it had fallen below 6. Nominal returns over that period looked respectable in dollars. In gold, severely negative. Real estate, perhaps the most systematically distorted asset class of all. Property is part physical, part financial. It reflects real constraints on land and location. But it also reflects, very powerfully, the cost and availability of credit. A market inflated by a decade of suppressed rates and expanding mortgage credit can look like genuine scarcity in dollar terms. Priced in gold, the credit component becomes visible and separable from the genuine scarcity component. Oil, priced in gold, deserves particular attention right now. Historically, the gold-to-oil ratio oscillates within a recognizable range that reflects the intersection of energy supply conditions and monetary credibility. When it dislocates dramatically from that range, as it did during COVID, and again recently in ways that are unusual by any 80-year standard, it is registering something that goes beyond the normal commodity cycle. Either the monetary regime is shifting in ways that gold is starting to price, or energy is undergoing a genuine structural repricing, or both. across every asset class, across every historical period. The gold view points toward a conclusion that mainstream financial commentary rarely states directly. The majority of major currencies have been in a long, slow, but ultimately dramatic depreciation against gold, interrupted periodically by episodes of restored confidence, but never reversed across the full arc of the post-1971 era. The question is not whether currencies depreciate against gold. They do. The only variable across different systems and time periods is the rate. Some go quickly through fiscal crisis, hyperinflation, or balance of payments collapse. Others go slowly, almost imperceptibly in any given year, but with consequences that accumulate across decades and become undeniable across generations. The Swiss franc, the Japanese yen, the euro, all have depreciated against gold since 1971, some more slowly than others. None has maintained its purchasing power against the one monetary asset whose supply cannot be expanded by institutional decision. What we've done in these 8 minutes is not a prediction about the short-term direction of gold. Gold is volatile. It overshoots. It can fall sharply and for extended periods when monetary confidence recovers or when real rates rise. What this is a method of intellectual hygiene, a way of enforcing the separation between two things that are systematically conflated in most financial analysis: changes in the world and changes in the unit used to measure the world. That separation is not optional for anyone who wants to think clearly about value, cost, and the preservation of purchasing power across monetary regimes. The ruler matters. It has always mattered. The evidence of 2 centuries of commodity data, equity returns, real estate cycles, and energy markets is consistent on this point. When the ruler changes, the story changes. Not always dramatically in any given year, but inexorably, across time. And for now, the data is unambiguous on one final point. Measured against the one monetary instrument whose supply the financial system cannot control, the world's major currencies have moved in one direction across the past half-century. Every one of them. The only question, the one every long-term investor, every saver, every policymaker eventually faces, is how quickly. This is Game of Francs. The full article, with the charts, the data, and the methodology, is at gameoffrancs.com. Subscribe for the next one.